There is a sentence that will send a small shock of recognition through anyone who has studied American financial history. The rules changed at midnight. It happened in January of 1980, when the men who ran the commodity exchange decided that two Texas brothers named Hunt had accumulated rather too much silver and enacted what they called Silver Rule 7. It happened again in the spring of 2011, when the same exchange, now absorbed into the entity known as CME Group, raised margin requirements 5 separate times in 9 days, and silver, which had been climbing toward $50 an ounce on the back of post-financial crisis optimism and borrowed money, fell by nearly 30% over the following weeks. And it happened again, with a quiet institutional thoroughness that should command your attention, beginning on the 26th of December 2025, a day when most Americans were eating leftover ham and watching bowl games, when CME Group announced the first of what would become a series of margin requirement increases for silver futures contracts, the second round following just days later on December 30th, raising silver margins by roughly 30%, forcing leveraged traders to either post dramatically more collateral or liquidate their positions entirely. What followed was a price correction of approximately 17%. Silver, which had been roaring toward its all-time nominal high, was handed a cold shower. Now you might ask why any of this matters to you, sitting wherever you are today with silver trading at roughly $75 an ounce, the live spot price as of this morning standing at approximately $75.40 per ounce, a figure that, if you had been told it 5 years ago, would have seemed like the premise of a financial thriller rather than a news report. It matters because the mechanism used to slow silver's ascent in December of last year is the same mechanism that has been deployed with remarkable consistency at every significant inflection point in silver's modern history. And understanding it is not merely an academic exercise. It is, if you will permit a slightly elevated claim, a matter of financial self-determination. Let us begin where all honest discussions of silver must begin, with the Hunt brothers, because their story is the master text from which every subsequent chapter has been written. Nelson Lamar and William Hunt began buying silver in 1973, when the price was approximately $150 per ounce. Over the following 6 years, they accumulated what became a staggering position. The Hunt brothers accumulated more than 200 million ounces of silver, leveraging futures to push prices close to $50. This was not a casual investment. It was a considered philosophical bet that the dollar, unmoored from gold since Nixon's 1971 decision, was destined to depreciate, and that silver, tangible, finite, industrially necessary, would serve as the vehicle for preserving their family's wealth. They were, in the broadest sense, correct about the diagnosis. Their error was the vehicle they chose to express it, because futures markets run on leverage, and leverage is the instrument through which exchanges exercise ultimate control. When the exchange decides that a position has become too large, too destabilizing, or simply too inconvenient, it possesses a lever of extraordinary power. It can raise the margin, the collateral required to hold each contract. In January of 1980, the CME enacted Silver Rule 7, which imposed stringent restrictions on the purchase of silver futures on margin, significantly increasing the amount of collateral required of traders and effectively halting new margin buying. Simultaneously, Paul Volcker, in one of the most consequential acts of monetary statesmanship in American history, drove interest rates toward 20%, making borrowed money suddenly, savagely expensive. Under the dual pressures of margin calls and broken funding chains, the Hunt brothers were forced to liquidate their positions and declare bankruptcy, sending silver prices crashing to $10. A fortune of nearly $5 billion dissolved in a matter of weeks. What you should carry forward from the Hunt brothers' story is not the lurid drama of billionaires bankrupted, though that is genuinely compelling. What you should carry forward is a structural insight. In a leveraged futures market, the entity that sets the margin requirement has enormous influence over the price, regardless of what supply and demand might otherwise suggest. This is not a conspiracy. It is arithmetic. It is how the system was designed to function, and it functions accordingly. If the Hunt brothers represent the founding myth of silver market intervention, the original cautionary tale, then 2011 represents the proof of concept that the lesson had not been absorbed, or perhaps more charitably, that the lesson is simply very difficult to absorb when silver is rising 4% a week and everyone around you appears to be becoming wealthy. After the 2008 financial crisis, the Federal Reserve implemented zero interest rate policies and quantitative easing, driving silver from $8.50 to $50 within 2 years, a surge of 500%. The mechanism was familiar. Cheap money flooded into commodities, leverage multiplied, and silver became the high-octane expression of a broader anxiety about what the Fed's balance sheet expansion might eventually mean for the purchasing power of the dollar. The rally had genuine fundamental support. It also had enormous quantities of borrowed money behind it, and that combination is one that exchanges treat as a form of institutional heartburn. In 2011, COMEX raised silver margins 5 times in 9 days. Margins went from 4% of notional, which allowed 25x leverage, to 10%, which allowed 10x leverage. The leverage collapse triggered forced liquidation, and silver crashed from $49 to $26 in weeks. Note the precision of that mechanism. The underlying demand for silver did not evaporate. The solar industry did not suddenly decide it needed less. Industrial users did not cancel their orders. What happened was purely financial. The cost of holding a leveraged position became untenable, and holders sold not because they had changed their minds about silver, but because they had run out of margin. Now here is where the story becomes genuinely interesting, and where I ask you, if you have not already, to consider subscribing to this channel. Because what I'm about to describe is a development that most financial commentary has treated as a footnote, when it is in fact the headline. If the information I am sharing is helping you understand silver's history more clearly, hitting that subscribe button ensures you don't miss what comes next in this story, because the next chapter is still being written in real time. In late December of 2025, as silver was surging toward what would become a nominal all-time high of $121.67 set on January 29, 2026, a figure that would have seemed delusional at the start of 2024, CME Group reached for the familiar instrument. Silver's recent rally faced a sharp correction after CME Group raised margin requirements by 30%, triggering forced liquidations and a 17% price drop. The playbook was identical to 2011. The players were different, but the choreography was the same. Prices rise, leverage builds, exchange raises collateral requirements, traders sell not from conviction, but from compulsion. But here is what happened next, and this is the part that demands careful thought. On January 13, 2026, CME Group announced something genuinely novel. As of January 13th, the CME would set margins for gold, silver, platinum, and palladium based on a percentage of contract value rather than fixed dollar amounts. Under this new system, silver contracts would carry a 9% requirement. The stated rationale was one of administrative tidiness. A percentage-based system scales automatically with price, eliminating the need for the kind of ad hoc emergency adjustments that had become a recurring feature of the precious metals markets. But consider what a transition to percentage-based margins actually means in practice, given where silver was trading at the time of the announcement. If silver is at $75 an ounce and a standard COMEX contract covers 5,000 ounces, the contract's notional value is $375,000. 9% of that is $33,150 in required margin. Compare that to the $25,000 requirement that had just been imposed during the December hike. The new percentage-based system at those price levels actually implied a reduction in the absolute dollar margin required, roughly a 22% decrease from the peak December requirement. The exchange that had spent weeks raising margins to cool the rally had, in one announcement, restructured the entire framework in a way that functionally loosened requirements at prevailing prices. One strategist at Overseas Chinese Banking Corp observed that the percentage-based method would intuitively capture the required margin without needing frequent adjustment. That is an admirably neutral way of describing what was, in effect, a fundamental change in the rules of engagement, one that, unlike the margin hikes, received rather less dramatic coverage. There is a question lurking beneath all of this history that is far more important than any specific price level, and it is the question of what silver actually is, not in a geological or chemical sense, but in an economic and civilizational one. Because the answer to that question determines how you should think about every margin hike, every rule change, every institutional maneuver that has been cataloged in the preceding pages of this story. Silver's price has improved more than 150% over the past year, reaching decade-high levels. Silver and platinum prices more than doubled in 2025, bolstered by multiple factors including physical market shortages and increasing industrial demand. These are not the statistics of a metal whose significance is merely ornamental. They are the statistics of a material whose industrial biography has become, in the early 21st century, inseparable from the energy transition that every major economy in the world has nominally committed itself to pursuing. Solar panels require silver. Electric vehicles require silver. The semiconductor supply chains that underpin artificial intelligence require silver. You cannot decarbonize an economy and simultaneously treat the metal most central to that decarbonization as a financial toy to be managed through margin adjustments. The silver market has been in a supply deficit for the past 6 years, and above-ground stocks are beginning to deplete. Shortages at the exchanges, intense industrial demand, uncertainty from tariffs, and a more liquid, decentralized, and global silver market are defining the current leg of the rally. What this means, expressed in the plainest possible terms, is that the forces driving silver higher in 2025 and into 2026 are categorically different from the forces that drove it higher in 1980 or 2011. The Hunt brothers were financial actors executing a leveraged speculation. The solar industry, the semiconductor manufacturers, and the electric vehicle supply chain are physical actors with irreplaceable material requirements. You can margin call a speculator. You cannot margin call a factory. Current COMEX margins are already at 17% of notional, meaning we are starting at a tighter point than the worst moment of 2011. Another hike would not trigger a 2011-style liquidation cascade so much as it would hit the hedgers, producers trying to lock in prices and refiners managing inventory risk. Push margins too high and you do not get forced liquidation. You get reduced liquidity, wider spreads, and commercials migrating to OTC markets. This is not a prediction of doom. It is a description of how leverage-constrained markets behave when the underlying physical reality refuses to accommodate the preferences of the paper market. The exchanges raised margin requirements, as they did in 1980 and 2011. While this has introduced some volatility, it has not reversed the current trend. The nominal record high is 121.67, set on January 29, 2026. The fact that 6 margin hikes and a fundamental restructuring of the margin methodology did not return silver to its pre-rally levels should tell you something. It should tell you that the physical reality of this market is increasingly resistant to the financial mechanics that have historically been sufficient to break silver rallies. What does all of this add up to for someone trying to make sense of the silver market in April of 2026, with spot prices hovering around $75 and the memory of January's all-time high still fresh? It adds up, I would suggest, to a set of questions rather than a set of answers. It adds up to the recognition that silver exists simultaneously in 2 markets: a paper market governed by margin requirements, leverage ratios, and institutional mechanics, and a physical market governed by the brute reality of mine output, industrial consumption, and above-ground inventory. For most of silver's modern history, the paper market has been large enough and liquid enough to dominate the price-setting function. Whether that remains true, given the structural deficits and the irreplaceable industrial demand now competing for the same ounces, is perhaps the most consequential open question in the precious metals space. The exchange can change the rules. It demonstrated that in 1980, in 2011, and again in late 2025. What it cannot do, and what no institution of any kind has ever managed to do, is alter the physical inventory of a finite natural resource through an administrative memo. Silver that has been consumed in a solar panel is not coming back. Silver that has been consumed in a semiconductor is not coming back. The question of whether the paper price and the physical reality eventually converge, and on what terms, is the question that animates the entire debate. It is a question worth asking. It is a question worth your continued attention. Before you leave, I want to ask you directly, do you think the margin hike mechanism that broke the Hunt brothers and cooled the 2011 rally is as effective in a world where industrial demand, not speculative leverage, is the primary driver of silver's move? Drop your answer in the comments. The quality of the thinking in this community is genuinely remarkable, and your perspective on that specific question matters more than you might think. The more clearly we collectively understand the mechanics of this market, the better equipped we all are to think through what comes next. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.